Good afternoon, ladies and gentlemen. I'm Frédéric Courtois, and I'm really happy to moderate this panel on making regulation fit for the future. Big program. And after listening to Michaela this morning, and as a sponsor for diversity and inclusion in Generali, I cannot avoid to notice that we are not a 100% women panel. But I'm sure it will be a very good panel. So I will ask everybody to introduce himself quickly. Paweł.
So Paweł Surówka, CEO of PZU, which is an insurance company based in Warsaw, with operations in Poland, Lithuania, Netherlands, Estonia, and Ukraine.
Minoru Aosaki from Japan FSA, Director of International Insurance Regulation. Thank you.
Lard, Friese, CEO of NN Group for an insurance and asset management group in 18 countries.
Gabriel, Bernardino, Chairman of EIOPA, Europe.
I'm Frédéric Courtois, I'm the General Manager in Generali. So we are going to discuss about regulation, and we will address mainly three chapters, so regulation and new technologies, regulation and long-term investments, long-term products, and at the end, regulation and climate change and sustainability. But before entering into these three chapters, Aosaki-san, you have the privilege to set the scene when Japan is the chairman of the G20. So I'd like first to welcome you warmly. So you come from far, you know that I've been in Japan for long, so Japan is a country I love. And I would be happy to listen to you on what are the priorities of Japan with this chairmanship, what are the subjects to tackle, and how you more globally you view all these topics.
Okay, thank you. So Japan holds a G20 presidency this year, and we have the three priorities in the financial sector. The first one is the financial inclusion in an aging society. The second, the opportunities and the challenges in for the technological innovations. The third one is addressing the market fragmentation issues. We also, out of the scope of the G20, we also discussed about sustainability issues for the climate change issues. But this is outside of the scope of G20. We actively involved in the discussion, involved in dialogue with the industry, but this is out of the G20. So here I'd like to talk briefly discuss the aging issues and innovation issues to facilitate the discussion for further in this panel. Okay. So Japan is the front runner for the aging society. About 30% of the population is already more than 65 years old. So we think this is not only a Japan issue for advanced countries. We see that emerging market economies in developing countries also experiencing a rapid change in the demographics. So we set a theme here on the aging societies. So in general, aging issues will create two types of the problem. The first one is if you live longer, you need more money to live. So the issue is related to the retirement saving. The second issue is that cognitive or physical decline will make it harder for the financial decision making. So we see that these challenges, but this challenge could be the transfer or turn into the opportunities if the industry provide a solution to these challenges. So the issue is here we're discussing that what action the financial industry can take to turn these challenges into the business opportunities, thereby help the society for overcome the challenges. Regarding the technological innovation, last year, G20 leaders agreed that realize the potential opportunities from benefits of technology while mitigating the risk. So the issue is how we can balance between protecting or promoting innovation and protecting the financial stability and consumer protection. So we particularly discussed the case of the cryptocurrency during the G20 meetings. So we saw the difficulties to rely only on the regulations, traditional approach of ensuring public interest. Why? We see the three issues. First of all, the speed of the development, the innovation is quite fast, so that the regulators to catch up with is difficult. The second, current regulatory framework is entity-based, so that financial regulation and insurance regulation, banking regulation is separate. So that the financial technology enables the financial provider to unbundle functions of financial services. The third, the advent of the decentralized financial technology, something like a blockchain, enable financial transaction without financial intermediaries. So we discussed how the innovation poses challenges for the regulators too.
Thank you. Reaction from you, gentlemen, especially on the aging issue, which is a subject we have in Europe.
Well, we have the same. And you know what? In 20 years' time, the European Union will be what Japan is now. You know, by that time, you will have, like you have, a third of the people being older than 65. I think that longevity is a risk that we need to spend more time on in the European debate, and especially with governments. So I think we need to have a more, in my view, industry-government debate about the transition of that intergenerational risk. And I believe there is a role to be played, and I said it last year in Madrid, I'm going to say it again, for the concept of longevity bonds, where you can, and I know there's a lot of hair around the concept, but if you can create a capital market where the global capital markets are going to help to fund and to manage over time a longevity risk, I think this may be one of the components that could contribute to prepare for this.
Gabriel?
I totally agree with that, and actually I think that the longevity bonds will be quite a good fit for the long-term investment in pension products, for example, by the industry. So
Absolutely.
that will be a good fit. But I just wanted to make a point about the aging element, which is also, you know, the product innovation by the insurance sector in relation to the decumulation phase. Because we talk very often, of course, on the accumulation, and we need to have it. But I think innovation in the decumulation phase, taking into account that we'll all live longer, but probably we'll all have periods of our life where dependency will increase. I think that industry, the insurance industry, is quite well placed to develop new ideas, new products, where the decumulation phase could be seen from a different way in the aging society.
And another area which is obviously also very lively debated in the Polish market is the entire healthcare issue that goes with it. Because while average life expectancy has gone up most around the world, in Japan, I think women are right now 91 years average, which is incredible. But the problem is that in the same time, life expectancy in good health worldwide has gone down. And this creates a certain span where the question is, what is the life quality that people can expect for? And I think that poses a lot of challenges for the healthcare sector, with a lot of opportunities and promises that we have in terms of technology, and particularly the technology that allows us to adapt the kind of lifestyle that prepares us for this kind of life, and which is not only a Japanese problem, it's a problem all over the world, particularly, for example, the United States. And I think this is something where the insurance industry has a great role to play.
Well, there may be actually one more dimension in which Japan is leading the way, or showing the way, which is that the European Union now is suffering from low rates, something that you and your country have been living with for a very, very long time. I certainly do not hope that 20 years from now the rates are still where they are today. But unfortunately, the key dynamics today are basically showing that there's not much expectation, barring a massive shift in productivity driven by technology, that things will change pretty soon. So I think there's another issue here, which is people need to save more, not less. They need to accumulate more, not less. But in a situation where rates are not going to help them much, so this means more risk taking. And here's a big concern that I have. We have, as an industry, always had a very important raison d'etre. And the raison d'etre is that we take risk from consumers on our balance sheets, and we take that through cycles. That's what our job is, right? At this moment, we're actually diminishing the guarantees that we are providing to customers because they're unaffordable, because of low rates and longevity, etc. And here we are. I think now market risk is shifting to consumers, and they will have to make choices. My question to the audience and to you is, do they really have the know-how, the expertise, and the interest to make responsible and good investment decisions? And if not, how are we going to help everybody to be educated well enough to deal with it? That's another challenge.
And we have
No, I agree with that, and my answer would be that no. As a normal man in the street, probably is not equipped to deal with that. Financial education, of course, is very important. It can help, but it's not a substitute. And I think in that area, we don't need to reinvent the wheel. Also, we need to see the type of solutions that have been working around the world. For example, having the default mechanisms that most of the people will adhere to. And of course, then also bringing the quality of investment and the quality of service provided by the sector. But of course also, and I'm sure we'll come back to that, to have the opportunity to still have guarantees in the system for the persons that would like to play.
Great.
Yeah.
And I would favor mandatory financial education in all schools.
Yeah, kudos to what has been said
Yes,
before.
indeed. Actually, Romania is doing, I think, very important things, and the industry is also contributing a lot to this. So really sharp.
on all of this, clearly Japan is leading the way, so this is interesting for us to look at what you're doing. We are still relatively unprepared in Europe. This is about pension, but we are going to discuss pension. We can think about long-term care, and here the US experience is probably not the right one, so we are all a little bit shy on long-term care. But I think as insurance companies, we have to bring something to the table on this. And we are only at the beginning.
Can I chip in one more thing that I think that Japan is right? You will feel really good about your country when you is that, if I'm not mistaken, Japan is also leading the way when it comes down to health checks, particularly company sponsored. I think after a certain age, 30, 40, you do health checks pretty much every year, which I think is a fantastic basis on, doing further on prevention. And I think this should be something also that we should really look at here in Europe.
Yeah, I like me to think that in France, there have been studies recently on the fact that a lot of people see a doctor only with the compulsory visit organized by their company. So this is the way to do prevention. So let's move to our first chapter after this interesting introduction about technology. Paweł, I've read your new strategic plan, very much, not all of it, a summary, very much focused on technology and digital. So I'd be happy to have your view on, first, on a bit of your plan about regulations. So does regulation help or doesn't it help? About how do you take into account the opinion from your customers? And last but not least, I understand you also have a bank in your group. I think that's interesting for us. Banks for us are partners and competitors. I would be interested to have your view on, are they really ahead, the banks, compared to the insurance companies?
Well, thank you very much. Honestly, when we wrote the strategy, we had no idea that the vice president of Generali is going to read it. This is
Not disclose so much.
we would have put more thought into it. But it's for us it was pretty clear that the technology is really going to change the way not only that we sell insurance products, but the way the insurance products are going to look like. And obviously for us the question was, are we going to consider this as a potential threat to us and just see where competitors go and then try to be fast followers? Or do we see it as an opportunity and we just try to embrace it? And we thought that, in a certain extent, it is a competitive advantage that we can use if we are fast enough to really embrace those advantages and really use it for changing some of the challenges that we are facing right now. For example, the healthcare system that in Poland everybody agrees could work better. So we said, well, let's jump on that ship. Let's really try to embrace it and think about how we can harness technology. And as a matter of fact, to your question on regulation, we believe that the right amount of regulation is actually going to be helpful in digitizing our companies and putting up a new digital transformation. And there might be something controversial. I've been to X panels where people from Europe would be saying, "Oh my God, this regulation is killing us in terms of competitiveness to the Chinese, for example, and they're having all this big data." What we see, we have currently in our company changed completely the way that we think about car insurance, changed the way that we think about investing, and also particularly about healthcare insurance. And we see that the biggest bottleneck to it is the trust that people have in entrusting your data. And when we go further down the line, and we go, for example, for gene sequencing, currently we were looking at a project where we're saying, okay, let's offer free analysis of your genetic to all of our health insurance patients. You really cross a path where customers are really going to ask themselves the questions, is this data safe with same as insurer? And I think that if you have a level field where people generally have trust in the system, that ownership of their data is really boiled down to the use that they have accepted to, and it's not going to be used against them, then it will be actually easier for us to compete around it with our products. It will be easier for us to get the flow of data running and actually harness all those elements that I believe will be extremely powerful to change the entire way that we work forward. I'm not reinventing the wheel. It will change completely the way that insurers work. It has been said before by the MEP. You will go down from a route of risk pooling to be more a partner of your clients and actually helping them to plan their lives and to think about the way that they manage the risks, being the risk of longevity, being the risk of outliving your assets, being the less risk, your individual health risk that you're facing. And I think that we will completely rethink the way how we price those products and how we price this product over the lifespan of the customers. But I believe that if we find the right elements to really clear the play field of trust and the way that data is working, the way that consumers understand that data is the currency that they receive certain products with, we will actually help ourselves in unblocking some of the elements that we struggle with.
And on banks?
So, our view when we acquired the banks was that, to a certain extent, the dividing lines between, that you've touched upon, the division lines between financial products like banking products, insurance products, investment products will blur over time. And there will be, the actual difference will be things that you will, be able to buy in a digital way that will be kind of bundled into other products, and you will have in terms of a microform. And, the big products that you will want to discuss with your financial advisor, and then will all span around actually, planning your financial well-being over time. And we were asking ourselves the question, where is this conversation going to take place in the future? And we have to say to ourselves, banks are probably better equipped with the knowledge that they have with the customers, with also the education of the front officers, to have this conversation going forward. And we said, okay, we want to be part of this conversation. And that's why we thought that, it was important for us not to see banks only as a distribution channel. It was important to us to see banks as a partner that help us educate the customers. So right now, what we do immensely is to invest in the IT systems and particularly educational systems with the front office employees of the banks that we own, in order to make sure that they are able seamlessly to speak about banking products and insurance products at the same time. That was part of the strategy, and we do see that plays a big difference.
Aosaki-san, will you briefly touch on the issue? Are there any lessons from Japan on this, on new technologies, and how do you approach this as the FSA?
Yes. There's a couple of thoughts, I think. So we are now seeing a customization of the insurance. So we see that the insurers use the data from health check record or the driver's record, and so you use data for customer insurance. And what we are worrying about is that this could be the financial exclusion, and this could be financial inclusion. So that if you, we always talk about that. So high risk people, who have a cancer, could be, really will not be protected by the benefit of the insurance in the future. If the insurance companies use the data for customer. And what was the role of insurance? The insurance was kind of a mutual protection scheme in the past, but we are now seeing a change in the role of the insurance. So the technological innovation could change, the role of insurance, but we are worried that this could be an exclusion from yeah.
People can't get insurance anymore.
Yeah.
And that's a big concern.
Question.
Now,
Yeah, so,
any
yeah.
reaction to this?
Yes, so there is one reaction I have is because your first question was, is regulation, to what extent is regulation be adapted or otherwise to further innovation, etc. Because I completely concur with you, and with you that we will all be touched massively. We are already touched on a daily basis by the use of new intuitive technology and data to help make our lives more easy and convenient. And as a result, there's only one choice, and that's to go fully for it. And that's what we all do, all companies do. Now, when it comes to regulation, what I find interesting in the debate, I really question whether you're getting the balance right. Because if you, for instance, if you go to China, they take a different approach to this. So if you have a new piece of innovation or new technology, you could either start the discussion by saying, how do we contain it? What are the potential problems that we can envisage with it? What are the ethical concerns that may arise around it? And let's first, put all the emphasis in intellectual brain capacity on that. And that's one way of approaching it. And I'm making a caricature out of it just to make the point. The other way of approaching it is to say, you know what? There is technology out there. There's new stuff. It's an adventure. Let that technology blossom. Let's see what it can do. Let's see how business models can be created. Let's speed it up. Let's make sure it accelerates. And then, at the point that it gets to a certain level of maturity, you start to say, oh, wait a minute. Now we need to make sure that we rein it back in. That's another approach to regulation. In the one approach, it takes a huge amount of time to get new technologies and business models to be developed. In the other approach, it races forward much faster than in any other part of the world. And, you know, what's the better one? Now, don't get me wrong. This industry is not Uber. So this industry is not Uber. So if the Uber app doesn't work in London, you take the tube. And if we have an issue, of course, the lives of many households are in trouble. And I get that completely. My only question is, do we have the balance right?
No, I think that's the important point. That's what I was thinking on. I think the issue is about the balance. But I think the most important thing, I believe, is the point of departure. And I really believe that we should not try in Europe to copy other models around the world, be it, you know, China, US model. We should be proud of, you know, what is our history, what our values in Europe, this element of, you know, protection of data, this element of security of your data. This is something which I think it's a value that we have in our society. And we should build business models that depart from this principle, which I think it's an asset. And I firmly believe that as things go, you know, move also internationally, you will see also in other continents this element of having a sound protection, a sound basis of protection of the consumers being the basis for sound business models. So that's my point of departure. Then, to your point in terms of how to approach it, I think there's a balance in there. And I think also from the regulatory community, I think we see that, you know. We know, of course, that all over Europe and in many countries there have been this development of sandboxes, innovation hubs, etc. You know, I don't want to say that they are working perfectly or that are not working at all. We're seeing some things, some good dialogue coming from this. We're doing now a network of these sandboxes, innovation hubs at European level to try to put all the persons, of course, talking together, because there's an element in Europe that we need also to touch upon, which is the scale-up. And I'm not talking about scale-up of insurtechs or whatever, I'm talking about scale-up of digital business models. Because if we continue to just look at your own national rules, and especially in the area of conduct of business, to be very honest, we will have very difficult situation of really enabling the scaling up of digital business models. We should think of this at the European basis and to think what should be the kind of you know, digital first framework to make these businesses go up. I'm very happy to see that there's, of course, this strategies from the company on innovation and on digital, because, you know, in any way there's no other way. You know, we all need to embrace it, and be it the industry, be it the regulators, you know, and we always make this point that we are, of course, by default technological neutral, and that's, I think, very important. I totally agree with what Paweł was saying. But for example, what we see now after, you know, this report that we just published recently on the big data analytics used in the insurance sector on water and health, where we see really that the insurance sector is, you know, starting to really get pace and a trend towards more use of artificial intelligence, machine learning tools, etc. It's clear that there is an element of you know, lack of clarity of where the boundaries are of this usage. And so I think that what we should do is to build up on the work that the European Commission has been doing on, you know, establishing across the board principles for the use of AI, and to look at the insurance sector and to develop what I used to call principles of digital responsibility in insurance that will be applied by everybody. Because that's what I think will guarantee that, irrespectively of the business model comes from, you know, a traditional company, an insurtech, a big technological firm, that we have this basis that people can trust. Because that's, I think, also an important element. Believe me, many times I talk with consumer associations in Europe, there's still not a buy-in in terms of the value that technology and innovation can bring in the insurance arena. So I think we need to deal with this perception and to develop that level of principles of digital responsibility in insurance. I think it would be a very important point. We're looking forward to dealing with all stakeholders on this.
Paweł, you want to say something?
Yeah, just to re-stress Lars' point about, you know, do you regulate first and innovate later, or do you innovate first and regulate later? while I completely agree with that, the fact that probably the biggest handicap in Europe that we have in terms of running businesses, digital business models, is scalability of business models. The problem here is regulation. It's not a help, but the way the report and Gabriel and I are having this discussion differ a little bit is, how do you overcome scalability? And to say it mildly, I don't believe that when you put regulation of innovation on a European level, you necessarily make things easier and make things faster, to say it, for the least. And I believe that, somebody recently compared this to the seatbelt model, right? You would have first cars, and then you would have accidents, and at some point people said, okay, let's put seatbelt in those cars. And we are right now in the seatbelt movement of a lot of technology where people say, we need some regulation. But the thing is that you need to allow yourself to have those cars on the street, because when you only set the frameworks and you say, okay, this is the framework, please innovate, then there is a certain risk that the most innovative stuff is going to come from the United States and from Asia. And I think that we need to be able to allow some space where there will be some car accidents, and we say, okay, we need those seatbelts on.
I think, to conclude this first chapter, Gabriel, I think you're right. And the role of the regulator is to design the boundaries, the rules of the game. And if I take two examples, this is what has been done on data protection, then we could challenge whether the balance is right or not. Clearly, we do not have the same balance as the US or China. Personally, I like the European balance, recognizing that it could put us, for the time being, at a disadvantage compared to some Chinese or US competitors, but the job was done. I think the threat we will have is mutualization, and making sure, and Aosaki-san, you mentioned it, that nobody is excluded. Making sure that because of the use of data, everybody can find insurance at a reasonable price. And I think we've not seen yet what will happen on this.
No, we have no evidence until now, let's be clear.
So let's move to long-term investments, pensions. Maybe I'll start with Poland, which is a big pension market. How do you view now the role of the regulator to promote long-term savings? I mean, we have a huge pension gap, we all recognize it, but we haven't really addressed the topic yet.
Yeah, I think, so first of all, pension systems in Europe are established everywhere, and the starting point is different from many markets. In some markets, large countries in Europe, you have mainly a publicly funded pension system. In markets like you see in Central and Eastern Europe, you have systems, two, second or third, three-pillar systems, which have been established only a decade ago, or even more recent. And you have other systems. So my point is, the points of departure are different, but the underlying need is the same, right? Which we just established with Aosaki-san's opening, which is that we all live longer, and whether it doesn't matter where in Europe and what political persuasion you have, you all live longer, you need to save more, and interest rates are very low. So what I believe is we need to have well-established pension systems everywhere, and pension systems need to have continuity. If you're asking people to start early, to commit some of their income to save for later, it is absolutely crucial that it's done in a system that is stable and that provides continuity. Otherwise, you're eroding the incentive for people to really start investing into their future. And in the end, if you don't do that as a government, you pay the bill yourself, because the ultimate carrier of all these risks are governments. Second thing is, you need incentives. So I would say incentivize the governments, incentivize through tax rules or by other means, incentivize your citizens to save and to build up their pension and retirement plans and start very, very early. Don't look at it as an expenditure, look at it as an investment. It is an investment because, again, in the end, governments are on the hook for their societies, and if they haven't saved, the bill is going to be placed there anyways. So you better invest in it in advance. It's way more effective. Thirdly, governance around pension systems need to be very well done so that people can trust that the people who are managing their pension money are regulated, are doing it in a good way, and fiduciary in a also very acceptable way. I think those principles are very important. Now, if I then look at the capital regime, Solvency II, and we do need to recognize that it's a one-year regime of shocks. It's also the market value measures, market value-based system, on a one-year basis. Well, these are 50-year cash flows, or 50-year liabilities, or longer sometimes. So I think what's most important is that the illiquid nature of the liabilities that you're actually getting yourself into, which are pension liabilities, that illiquidity is recognized in the framework. And while I think the current framework has elements of it, so don't get me wrong, I do think that can improve. And I would then submit to Gabriel, who's sitting next to me, who is leading the review of the framework that's currently ongoing. I would submit that illiquid nature of those liabilities, in order to facilitate all those people to have good pensions in a low-rate environment, please facilitate it. For instance, on the asset side, by being a bit more friendly on infrastructure investments, for instance, or on illiquid investments on the asset side. Please recognize the illiquid nature of the liabilities, and please recognize that also in the Solvency II framework, specifically for the asset side. I think that is going to be crucial. I'll let me stop there.
So that's a good transition to my next question to Gabriel. The simple message, Gabriel, is we need you. And I think we all recognize that Solvency II is a good framework globally.
Yes.
But it is clear that it does not incentivize long-term savings. So what can we do?
Well, I think let me start by this. What Oliver said this morning, I think it's really the important point. And we should not try to come back to a world where basically we were doing long-term guarantees, really hard ones, high ones, without sufficient capital. So I think, and I'm very happy to hear from the industry side that that's not the world that we want to come back, because that's, to be very honest, that's not worldwide. That's not the view.
Which was one of the big benefits.
That's not the common view. So let's take that. That's one of the benefits that we have. Now, with the review, definitely our aim is to fine-tune and complete the regime. And there's a number of elements, of course, that we will need to look upon, and this is one of them. You know that already more than 1 year ago, we've started at EIOPA to look precisely at this element of how can we better capture the truly illiquid type of liabilities. And I knew that this was going to be a difficult one, that's why I've started well ahead. We're progressing, we're getting, of course, data, we're having the discussions, and we will have during this year, of course, the opportunity to go deeper than in those elements. I continue to say, and this is a risk, of course, but as a regulator, you also need to take risks. I continue to say that we can have a better fine-tune than what we have right now in relation to capturing daily liquidity. I think that we can better have a fine-tune in terms of recognizing that if you have a truly illiquid type of product that has guarantees at the termination, that you don't guarantee all the time during the contract, so that the contract is much more illiquid, your liability is much more illiquid. That gives you, of course, a completely different picture in terms of the necessity that you will need to sell assets in an environment of volatility in the market. So I think that we can do better on that, but it's a fine tune. It's not something that we have the impression right now that we should completely change the approach of the regime. That there's too much capital or too less capital in the regime right now. I think that it's an element of fine tune, and I think we're gonna get there.
I think we can easily define some criteria on what is an illiquid product. As you said, a product that can be surrendered every day is not an illiquid product. It's relatively easy to define the criteria and then to come up with a conclusion on
We're working on that.
which
And also want to echo one thing that Gabriel was saying, which is about stability for Frankfurt, right? I believe, and I think we share that sentiment, is that Solvency II has been introduced in 2016. It is a regime that has taken the entire industry and its stakeholders 13 years to come to a certain level of introduction. It has now been introduced, but it's still, a relatively young regime. And for pension, but especially for life insurance and insurance companies, and for their stakeholders, for everybody to trust the regime, clients, investors, etc. I think it's very important that it stays also the stability to it. So the fine tuning on the liquidity side would be great, but stability is important.
So we'll have soon a concrete case. We have the PEP. So I'm asking our two CEOs, Paweł and Lard, a very simple question. Are you going to sell it?
Well, in all fairness, I think it's a great concept. And just to prove it to you, honestly, I think that if 1 year ago this product would have been rolled out, let's say the Polish market, it would have disrupted the entire market, particularly because of the 1% cap and the transparency. There has been excesses in the market, and we're not helping the market, to say the least. And this is a very Polish perspective, but for some reason, which was historically, fees in Poland were double or triple what they were in Western Europe, and which led to the fact that Poland right now is at the very trailing end of penetration of financial products and savings per income. So I think this product would have made a kill. Today, honestly, luckily we're in a little bit better position. Amongst others, and that was one of my big pet projects, we introduced passive investing for the first time in Poland. We set up a digital platform where everybody has access to a portfolio of passive funds that are all, and the entire fees are capped at 50 bits a year, everything in, which is a universe below what has been seen in Poland. As we speak right now, there's a new pension system that is being rolled out in Poland, a third pillar system that I think is very promising. It's going to be on a group basis, and it's going to, it's really starting 1st of July, so we have to see how it changes in the market. But it is also capped at 50 bits management fee, which means that there will be a very, very strong basis. And obviously Poland, with the wealth creation that we have right now, I understand that PAP is considering itself a symbiosis and a top-up of the national system, or an alternative to it. So my feeling is that we have to see how the current system will roll out. It's an employee-sponsored system, so employer-sponsored system. So we have to see how it will roll out. My feeling is that eventually, when it comes into action, let's say 2 years from now, the take-on from the Polish market that I know best might be limited. Having said that, being a country, we're not Generali or NN, but we still operate in a couple of markets. I think it will be very interesting to have one product at last we have one product that we distribute all over all the countries that do business in, and we hope to do more. So yes, when it comes out, we definitely will embrace it. Obviously, there's a ton of questions waiting, particularly the tax part. I really like to see how it's going to be addressed, because obviously, if it is France, Germany, Poland, tax incentives really differ and tax motivation differ. So I'd love to see how we work this out by crossing fingers.
Now, are you going to sell it?
I think, we're sympathetic to the idea. and constructive about it, but there's a lot more work that needs to be done before we really know what's going to happen. Because first, as you know, there's now level 1 approval or agreement, but now, of course, EIOPA, and the guidance of EIOPA, all the details are being sussed out. Actually, it's quite important, those details. They really matter. Because it also has to do with what is the documentation, what are the requirements going to be, how many times do you, how many mandatory times you need to ask advices, or give advice before the product can be bought. And then, of course, the final thing is on the guaranteed piece. If you have a 0% guarantee, which is a guarantee at maturity date, there's still a capital charge. Is that the right charge? Pick the earlier discussion. In order to make sure that it's really attractive, and then you have the tax angle. So I think we need to wait a little bit, but the idea itself, we're very constructive on.
Gabriel, you are the father of the PEP. So, and as our German friends would say, the devil is in the details.
Oh, yeah.
So, how to make it a big success, and what will be your priorities to make it a big success?
I think there are three main conditions in here. One, I'm really happy to see that the industry wants to engage. That's one of the important elements in here, and I really encourage all the insurance industry to work also with Insurance Europe to bring, to the debate that we're going to have during this year on the development of the secondary regulation in the PEP, to bring the ideas also from the insurance sector. I receive a lot of input also from the asset management, so I would like really to have this, in a more balanced way, if you know what I mean. Secondly, very importantly, second factor of success, it's tax, of course. And this is very important also that the industry can play a role towards the ministers around Europe, because this element of taking advantage of the cross-border nature of the product, I think it's a very important one. And this is also really the European mindset behind it. And the other element and the other factor for success is, of course, the development right now that we have. I would just like to mention three main things from our side. First, it's about, of course, having the criteria on defining the risk mitigation techniques that this basic PEP could be built on, which is basically a life cycle strategy of investment, and that's one thing that I really wanted to have there in the text, to have the possibility also to develop, pooling mechanisms and smoothing mechanisms that can also be used in the PEP. So this is very important. Second element, and fundamental, I would say, for the success of the PEP is really the transparency and the consistency of definitions in terms of costs and performance. This needs to be crystal clear. This needs to be expressed in a very clear way in the kit of the PEP. And there's no other way, my friends. We need to standardize this, to standardize the definitions. It doesn't make any sense. It creates huge confusion for the market by having completely different names, the definitions of different types of costs. That's not the way that competition should be there. Competition should be there on the service, on the product, on the investment that you can provide, not on the way that you express costs and you express your return. So this is an important, very important element. And what we want is that this is very clear and the most simple way possible in the kit. By the way, we want to develop the kit by default as digital. So that will be, I think, a very good step also in the direction of also the ones that we are trying to capture. Because the PEP is a project for the future. We are 50s. We're not, I will buy a PEP for sure if there's there, but it will not be so much for us. It's for the young generations. We need to make sure that we transmit the information in the best simple way in a digital manner. And overall, I think that there's a positive element in here where you can bring, the digital revolution. You can bring also the aspects that I believe we're going to talk also about sustainability and sustainable investments, and to put this in the context of long-term investment. So I think that the PEP can be a success, but it's up to all of us, to deliver now the next stage.
Aosaki-san, are there lessons from Japan on private pension?
Right. So we have a public pension system, and Well, it's interesting to see that the development path in the time. So, Gabriel came to Tokyo 2 years ago, and we talked about the issues, and it was still concept.
Yeah. Now it's reality. You can't love it.
And we learn a lot from the European experience, and in Japan, we also need to encourage young people who is still working and invest more money to their money too. And so in our case, we established individual savings accounts as a tool for the tax exemption purpose. But you know, this there's a limit on the investment amounts for every year, so that we also are aware that we need to improve every year, so that it seems like Gabriel said, it's like use of the innovation ratings, and so I guess that tech will also improve gradually.
Yeah.
Can I just make one point, because I forgot about that, and what about what states can do? And I think that the real elephant in the room in all this discussion of retirement savings, it's about somehow a level of compulsion or auto-enrollment for private pensions. I know that this is difficult to talk from a political perspective, but I don't think that there's another way. And the pensions gap will continue to increase if we don't do something in this area. And be it through individual pensions, be it through occupational pensions, we need to find a way to have an auto-enrollment system where people gradually would start, and to have this level of compulsion to have savings. I don't think that there's another way. So this is something that should be part also of the political discussions with Europe and the member states regarding retirement savings.
Thank you. So let's move to our third chapter, climate change and sustainability. And it's a question, it's a simple question to all of you, gentlemen. What is the situation in your respective countries? What is the mood? What is the discussion? And what could the regulator do to support our efforts? I don't know who want to start.
Well, okay. So in terms of ESG, we as a company, as Piece of View, we have embraced the multi-stakeholder concept some time now, and we absolutely want to benchmark ourselves against really the best standards. So first of all, we consider that obviously we want to create shareholder value, but we consider that stakeholders are just as much our clients, our employees, and the communities that we operate in, and obviously that includes the environment. So we have, from our point of view, embraced not only our own green policy, we've also issued green bonds, committed to green targets with the EBRD. We have also been, since many years now, on the Respect Index, which is the ESG benchmark on the Motor Stock Exchange. And we will probably soon publish our own goal on when we want to become CO2 neutral. So in this respect, as a company, we believe we want to be really measured against the highest standards. In all fairness and all transparency, we have not gone down the path of imposing those same standards on our clients, which, in all fairness, is something that some institutions or stakeholders demand of us. For the time being, we have considered that the most constructive approach to this is to state an example and to invest into the right solutions, not to be penalized. This is probably the policy that we have embraced for the moment as Piece of View.
Yeah, so on our company, we are on, this is core to who we are, actually, ESG. So we've embraced ESG for a long time. It's part of the ESG factors are part of our investment decisions, are part of the way we operate. We believe that our raison d'etre is more beyond the balance sheet, beyond the P&L. We should ensure that we contribute to make sure that we contribute to a good planet and to a good environment, so that we can pass it on to future generations in a good way. So we have a completely embedded practice on that in our investment processes, but also in the values of the company, the way we operate together as a team. We actually disclose this in a annual report, which we report quite heavily on also all the things we do around ESG. We are adhering to international standards there. We've also started 2 years ago to use the Bloomberg Task Force, as I call it, which is TCFD disclosures, and report on that quite extensively. We have a core practice, which is that we believe that every company we invest in, that we seek active engagement, as we call it, which means that we actively engage with the companies we invest in to ensure that their agenda is aligned, and that their agenda is also to push for the ESG factors in their way of working. We are actively doing that in shareholder meetings, in our voting stances that we take. But also, in all honesty, this is also a journey. Society continuously, brings dilemmas in front of you. So we write policy around those. We've published policies this year around tar sand, oil extracted from tar sands, and we're very clear about that. We're not investing in those producing or those who are managing that. We've joined the roundtable for sustainable palm oil. We've done many things in that dimension, and we are slowly but surely getting recognized for it. So we're in the Dow Jones Sustainability Index, we're in the FTSE for Good, we're being recognized by Sustainalytics and by others as one of the leaders in the field, and that is a journey. We're still having to work every day to make it happen. The dilemmas are all difficult because you got to make trade-offs continuously, but the direction of travel for us is
Aosaki-san.
Sustainability is one of the areas that GFC has a high interest, and our approach is like two. One is the basic awareness of the industry, and the second, it has the constructive dialogue with the investors. So from this kind of view, we encourage our industry support TCFD disclosures, and currently around 90 companies in Japan support TCFD recommendation, including the 11 insurance industries. And so doing that, also we do the survey for the whole industry with regarding the recognition of the TCFD. We hold that we establish TCFD consortium within May. That is a kind of forum for dialogue between the investors and the company who support TCFD, so that encourage the dialogue to increase enhance the way of the disclosure in a very meaningful way. So that's how we agree.
Gabriel, we see a lot of initiatives at the AU level. My worry is consistency. Are we doing it right?
Well, first, I think, and as you mentioned, this was really, I would say, a leadership issue from Europe, and I really want to thank the Commission, because I think this was an area where leadership is there. It's this old mantra that to do good management is to do things right. To be leader is to do the right things.
Yeah.
And I think that's what we've seen in here in serious leadership. And that's also, I think, what we all need, both from industry regulators in this area, because as we've heard today, this is of course a pressing issue, and we should all deal with it. Now, the way that we are approaching it from the regulatory perspective is of course in a step-by-step basis, and that, of course, your point and your question is a valid one. You know, how are we going to get to a consistent point in time? I hope so, and I believe so. But of course, we need to be quite attentive because many things are being developed in parallel, and so of course the end game may not be completely consistent. I think a lot of things depend, of course, on the taxonomy that is being developed, as we heard this morning, by the European Commission, and it will come hopefully also for the discussions at the end of this year. But of course, there are already steps that can be taken, and I'm very happy to see also that the insurance industry, European insurance industry, is taking leadership in this area. You know, things like what Lard was mentioning. I think this is very important. That what we have done actually, our recommendation to the Commission was basically to put in the regulatory requirements the good practices that we have seen already many in the market doing. So basically what we're saying is that we don't need to reinvent the wheel in Solvency II because Solvency II is a risk-based regime. But by the way, when you deal with risks, please don't forget that there are sustainability risks, that are ESG risks. You need to have a proper process to enter into your risk management process. And very clearly also from our side, and that's what I think the kind of innovation also, don't look just at investment, look at also at underwriting, because the insurance sector have also this power, of course, of influence and giving the right incentives to the real economy by doing, good risk-based pricing in terms of the risks on the underwriting side. So this, the most fundamental element, I would say, in the advice that we gave to the Commission, and I hope that this will be, of course, introduced then in the legislation, is this requirement for you to consider as part of your risk management process this element of the ESG risks, and to make sure that you have this stewardship, active engagement, as Lard called it, this stewardship role of insurers. That, by the way, it should be all institutional investors, that they should have this stewardship role towards the companies in which they invest, towards the companies in which they underwrite, the banks towards the companies to which they lend. Everybody should have this stewardship role because, surprise, surprise, this is not only good for the society, this is not something that we're doing for politicians. This is something that we're doing for all of us, for the clients and for the companies. And this is the fundamental point that we need to make. This is not just, to come there and to please some political wish list. No. There's evidence that, of course, this is an element that we as a society need to do. And the business models of insurance are probably some of the most effective. We've seen this morning. I was reading this report recently from the Zero Forum on the heat is on. And it's impressive, the level of problems that we will have on securability of risk, insurability, if the temperature goes beyond certain levels. So this is not about fancy political, ecological, whatever. I've said recently in my country in an interview that it's time for all of us to become ecologists, all of us. This cannot be just an issue that it's on a small part of the population. This is an issue for all of us as a society. And the insurance sector can, and I'm happy to see that this is the direction that we all go, can really contribute to this change, and to do it in a gradual way. Because the most important and difficult thing is that, if we, from one moment or the other, we collectively decide that we're not going to invest anymore in many projects or industries or economic factors out there, then we have a problem, because then we will have a huge bunch of stranded assets, and then we will have an issue. So we need to do this in a gradual way to make sure that we help this transition, and using the tools that the sector really has. You are the good risk managers that we have in the society. Please use that to deal with these risks.
No, I see some small reasons for hope. I think government, regulators, investors, and companies have started to act. So the direction is right overall. I mean, we've all started to act.
Yeah.
yes, you're right, we need to be gradual. My worry is, are we fast enough? And I'm not sure. And that's the big question.
Yes.
So now, as we have only less than 10 minutes left, gentlemen, I give 1 minute to each of you to give us one example, and I come back to regulation, of inconsistent regulation, regulation not fit for the future. Including you, Gabriel.
But let me read the one.
Who wants to start? Paweł, I see you want to start.
There is, I couldn't think of one actually. No. There is a couple of elements that need to be thought through. One of them, just to state the obvious one, is GDRP versus IDD. I mean, on the one hand, you're supposed to know everything about the client because you want to adapt the product to his need, you want to have something that is totally in line with the profile of the client. On the other hand, you're not supposed to know anything about it, forget everything. The implementation of GDRP, obviously this is all, you always have this triple layer of European directive, local implementation, local enforcement. And obviously there's a process in between, let's say this way. And when I, for example, look at the implementation of GDRP in our own country, in Poland, everybody has taken a different approach. Basically, it has resulted in an avalanche of spam mail, including, informing people about stuff they didn't know. Whether or not this has increased in an information level for the clients, I would ask the question. I don't think that today people, the way it has been implemented in our country has really, for the time being, resulted in them really understanding the concept of domain ownership. One very interesting one is implementation of MiFID II in, for example, Poland. It has resulted to a large extent in most banks and insurance companies deciding that if they are not able to take provisions from selling insurance products, that means they have to own an asset manager. And that means that most of financial companies right now have their own asset manager, which leads to the fact that you're going down a road of closed architecture rather than open architecture, which I don't believe was the intention of MiFID II when it was drafted in the first place. On the top of my head.
Thank you.
Over to you.
You first, I'll be first. Okay, so I'll give you I'll make two remarks. I think it's not only short. So one, I think, while I'm a fan of Solvency II, I do believe that we need to correct the illiquidity. We need to recognize in Solvency II, close the loop, the illiquid nature of the life insurance liability, and recognize that. Otherwise, we cannot help enough the screaming need of our customers for long-term savings and protecting themselves for their aging future. So that's the first thing. And the second thing I want to say is about regulation in general. If you want it future-proof, it needs to be simple, effective, and clear. And I think to one of the quotes from the members of parliament from the European Union was saying the same. We don't need big piles. Consumers don't need big piles of cumbersome regulation. We need crisp, clear, effective, and simple regulation. Like making a billy. Who has a billy from IKEA? I have a billy of IKEA. I'm a very awkward man, but I can put that together. Why? Because it's simple, it's clear, the manual is clear. I think that's kind of the roadmap that we should have for regulation.
Thank you. Aosaki-san?
In short, maybe the potential inconsistency would come from the data area. I mean, so I understand the EIOPA is study discussion of the ethical use of the data, and because ethical is maybe different from by jurisdictions, but so that if we the regulator touch on this going to be area, we may have some inconsistency. For example, in Japan, we always discussing about that in the Europe, the gender is not accepted to classify and divide each products, but in other countries, gender is one part of the issue. So issue using the data, if we regulate in some kind, we may have some consistency.
I'll intervene and let to Gabriel the conclusion, if you agree, Gabriel. I think we moved in the insurance balance sheet from not recognizing the losses 20 years ago to the dogma of everything should be mark-to-market. I think that's a misunderstanding of the insurance, of the long-term nature of the insurance business. Full stop. I'm not against mark-to-market. I'm against the dogma of everything mark-to-market.
Well, I think we don't have a dogma. What we need to see is, of course, how the adjustments that we put in there, if they really work and if they truly capture where we want to make adjustments. But coming to your question now, I just wanted also to make a reference to where I see inconsistencies. And I think the area that we should look more is on the conduct of business regulation, to be very honest, because this what we had with both at European level and even more at the national level. This was built up during the last 20 years with layers over layers and things to be put on top. And I'm not saying that they were all having good and sound objectives. Many of them I pushed them and I defended them. I think that we are at a point in time where if we really want to deliver on the basic needs of consumers from an insurance perspective, we need collectively to do much more simpler products. It's what Oliver mentioned this morning. I've been mentioning this for many years. This is the key issue. That's what consumers are asking. Simpler products. And simpler products, hopefully, will deliver also simple regulation, and this interacts. So I would really, push for having a thought about, also with the digital business models, as I mentioned, how can we have better conduct of business regulation that can deliver, more simplicity to the customers. It's difficult, I know, but this is the name that it's worthwhile to develop and to push forward. And my final point, I need to make it, of course, it's not all about regulation. I think that there's an issue overall in Europe, and I'm not talking about the insurance sector. I think it's an issue overall in Europe. We are very good in developing rules. We put everybody together, all the stakeholders, and we develop a lot of rules, etc. But then I think we're not as good in implementing, in supervising, and in enforcing them. So I would definitely prefer to go to a world, a future where we will have somehow less regulation, but better supervision and better enforcement. I think that this will be much more to the point of the interests of customers. And we are not there.
Ladies and gentlemen, I hope you enjoyed it. Thank you to our panelists.